Today we're talking about paying quarterly estimated taxes in retirement. I'm going to show you how the rules can put people on a roller coaster where one year they're paying little to no estimated taxes, and the next year they're paying huge estimates. This can be really frustrating and confusing to retirees. I've seen it happen with some of my clients. I'm going to show you how I like to deal with it. Now, in the U.S., we have a pay-as-you-go tax system, which means the IRS wants you paying taxes on income as it comes in. In contrast, they don't want you waiting all the way until December 31st of the year to write one big check for all the taxes that you owe. To prevent people from doing that, they will hit you with underpayment penalties, generally speaking, if you're not paying at least quarterly. Now, they also, recognizing the fact that people don't know what their income is going to be or their income is variable, provide two what we call safe harbor rules for paying taxes. And they basically say, if you do one of these two things, we're not going to charge you any underpayment penalties. Now, there's some issues with both of those approaches. One in particular can lead to this roller coaster effect I mentioned in the intro. That's what we're going to spend a little bit of time assessing here today. Now, let me kick things off with an example so I can illustrate to you these two safe harbor methods for paying quarterly estimates and what the shortcomings are. So I'm going to throw a hypothetical tax return up on the screen here, and we're going to say our example couple is Bob and Julie. They're both in their late 60s and they're retired. Notably, we're going back to 2023 for reasons you'll see in a moment. Now, let me just touch on their income composition here. Real briefly, they've got some interest income on line 2, some dividends on line 3, a pension for $30,000. On line 6, they have Social Security. This is the taxable portion over here for a gross income of $116,900. If we scroll to the bottom, here is their tax bill for the year. They're going to owe $7,747. Now, let's further assume that Bob and Julie have been making quarterly estimated tax payments throughout the course of the year, as opposed to withholding from their various sources of income. Now, what the IRS says, again, they give us these two approaches for paying quarterly estimates to avoid underpayment penalties. And the first one I want to mention works like this. The IRS says as long as Bob and Julie pay at least 90% of what their actual tax bill calculates out to be in the end, as long as they're within that 90% window, they will not owe any underpayment penalties. Now, this approach works well if someone's income is very consistent year to year, but it doesn't work well if income is variable. And a lot of retirees, of course, are living off investment portfolios, which can pay out big capital gains occasionally in irregular intervals, pushing their income way up. And thus, if Bob and Julie have a big capital gain next year, they might end up well short of that 90% window that we just mentioned. Now, the IRS, recognizing that people have variable income, give us an alternative safe harbor method for paying estimated taxes to avoid those underpayment penalties. So, for example, let's say Bob and Julie are expecting a real estate sale next year, and they know they're going to generate a significant profit, which pushes their income way up. Well, this causes a problem for them because they don't know what their tax bill is ultimately going to be. So what the IRS says in this second method is, okay, well, here's all you need to do. Look back at your last tax year, which for Bob and Julie would be 2023. And as for married couples, if your income's $150,000 or less, just pay the same amount in tax that you paid last year for quarterly estimates. So for them, it'd be $7,747 divided by 4. As long as they pay that amount in estimated taxes, no matter what their tax bill ends up being in 2024, even if it's $100,000, they're not going to get hit with any of those underpayment penalties. That's the second safe harbor rule. Now, let me just jump over to another screen and show you the income thresholds because it depends on your income. So Bob and Julie are in this category here. For higher income earners, if your income's $150,000, the safe harbor number is 110% of your last year's tax number. And for single filers, you can see what the various thresholds are. Now let's adjust the numbers on the tax return, and I want to illustrate to you how this second method can cause some problems in subsequent tax years. All right, well, let's fast forward a year. Now it's the 2024 tax filing season for Bob and Julie. All their income is basically stayed the same, except we're adding a big capital gain here on line 7 to account for the sale of some real estate that they've owned for 30 years. Obviously, you can see that pushes their gross income way up, and here's the tax bill down here on line 20. On line 24, it's over $48,000. Now, again, they're not going to have to worry about underpayment penalties this year so long as they chose that safe harbor method, the second that we talked about, where they paid 100% of their prior year's taxes over the 4 quarters this year. They're still going to have a big tax bill, obviously, but they're not going to have any penalties. But now I want you to think about next year, 2025, and how a big one-off year of income can cause issues for them. All right, well, continuing our example, let's think ahead to 2025. Bob and Julie's income is going down significantly because that real estate sale in 24 was a one-off. But herein lies the problem. If they are thinking about what to make for quarterly estimated taxes, and they're going to use the safe harbor number, which is just going off the prior year's tax return, well, obviously you can see the problem. Their income and tax bill for 2025 is going to look much more like 2023 as opposed to 24. But tax software is going to tell them their safe harbor number is not only going to be $48,056, it's actually going to be 110% of that because their gross income was over that $150,000 threshold. So this is an illustration of how that safe harbor rule, as I mentioned in the intro, can put people on this roller coaster of estimated taxes, where one year they paid very low estimated taxes, and the next year they were going to pay these huge estimates, which aren't really necessary. In fact, it's completely unnecessary, especially given that they know their income is going to be much lower. Now, finally, how do you deal with this issue where you have a one-off year where your income goes way up, and as a result, it pushes that safe harbor number way up, which, of course, ends up being inappropriate for the next year for the purposes of paying estimated taxes? Well, the short answer is you got to do some tax planning. You basically have to make your own estimate, and this is something I work with clients on all the time. In the case of Bob and Julie, as we know, that real estate sale was a one-off. All their other income was the same. So we could very easily just go back to 2023 and use that as a baseline for coming up with our own estimate in 2025. We would know with a very high level of certainty that we're going to get the estimates number very close. And if you're intimidated by that, you're going to have to work with a tax professional that knows how to do that. This is the type of work I do all the time with folks. But it makes a heck of a lot more sense to, spend a little time to figure it out than pay, tens of thousands of dollars in additional income tax that you're not ultimately going to owe. And unfortunately, I've seen that happen in a number of cases where, sometimes tax preparers aren't really thinking forward, and they just tell the client, well, this is what the software says is your safe harbor number, and here's what you're supposed to pay. It's like, well, let's think this through a little bit as to whether or not that's appropriate and make our own estimate. So anyway, this has been inspired from working with some real clients. I hope it was helpful. Thanks for watching. We'll see you on the next one.